morning, everyone watching live on BAM YouTube. Let me know in the comments where you are tuning in from. The Hot Sheet covers what you need to know about the real estate industry in a 24-hour time period. On today's Hot Sheet, I will discuss FHFA's decision to rescind its DTI LLPA fee, also known as the Biden fee, Lawrence Young's market forecast, the home buyer's quandary, and an update on jobless claims and regional banks. A lot to get into. Today is Wednesday, May 11th, 2023. I'm sorry, it is Thursday, May 11th, 2023. I am Byron Lazine, and let's get into it. The Hot Sheet starts now. All right, political pressure has caused the FHFA to crack. I'd love for you to consider cracking and hit the thumbs up right now. Would really appreciate it. And consider sharing the show with someone who wants a daily look at the housing industry. It's the only daily live show on the internet for housing. FHFA rescinds controversial DTI LLPA. So we spent a bunch of time talking about this. You know, Fox News called it the Biden administration mortgage fee that is subsidizing lower end, high risk borrowers with good credit borrowers. They made a huge deal about this. By the way, if you go on Fox News today, you won't find anything about this. This happened yesterday. They wrote, I don't know, 10 different stories about this, which went into effect May 1st officially. Many lenders were doing it prior to May 1st. We covered it a whole bunch on these streams. Now Fox News completely quiet. So when it was a political play, they were pumping it. And now that the FHFA has rescinded it, they haven't covered it once. It's been over 24 hours. They've had plenty of time with the amount of time that they spent writing articles attacking the new rule. They've had plenty of time to go ahead and then do a follow-up. They have yet to do that. This is why, especially if you're in the real estate industry, educating people in your database, educating people in your community. You do not want to follow mainstream media for real estate. I did another topic on the Real Word podcast on Tuesday where even a brilliant, sales guy, insurance guy, Patrick Bet-David, who is worth hundreds of millions of dollars, I did a reaction to a clip that he had where he was just using national mainstream media headlines and he had the data completely wrong. This is the show you want to be tuned into. Make sure you're subscribed here. All right. So the entire mortgage, according to Housing Wire, is shouting hip, hip, hooray. Now, I've personally spoken to lenders, and a lot of them did not say, a lot of them said this would not be that big of a deal. It would be more work for them. But in the conversations that I had, they didn't make it sound like the sky was falling in on them. The stance that the Housing Wire and the mortgage industry is taking, that certainly lobbied to help reverse this rule. They're singing a different tune. Okay, so the Federal Housing Finance Agency on Wednesday, just yesterday, announced that it would rescind a controversial loan level pricing adjustment. So all those green and red charts that were made up by Mortgage News Daily, they were beautiful. Don't need those anymore. This was a adjustment for just conventional buyers with debt to income DTI levels at or above 40%, right? The FHFA, which regulates Fannie Mae and Freddie Mac, so that's the majority of home loans, had previously delayed implementation of the DTI LLPA from May 1st, which is when it was supposed to go into effect, to August 1st, following a chorus of upset from mortgage industry stakeholders, including the influential Mortgage Bankers Association. I have quotes from the Mortgage Banker Association as well. I appreciate the feedback FHFA has received from the mortgage industry and other market participants about the challenges of implementing the DTI ratio-based fee. This is FHFA director. I'll get to Mortgage Banker Association's comments in a little bit. To continue this valuable dialogue, FHFA will provide additional transparency on the process for setting the enterprise's single-family guarantee fees that will request public input on this issue. Okay, so maybe you've had comments with lenders. Not many of them that I had conversations with said that this was going to completely disrupt their day-to-day. It was certainly going to be more work. It was a little bit more confusing But borrowers they're not going to be less confused today on how their fees work because of the reversal than they would have been, if this had happened. So it's not creating more clarity for borrowers, for home shoppers. I believe it does sound like it's making the job of lenders a little bit easier. And it sounds like that was the approach that they took, Mortgage Banker Association and the mortgage industry, in getting this reversed. More of, hey, this is going to be less confusing for borrowers, and it's going to be less confusing for people putting out the loans, as opposed to who is getting the benefit of a lower fee or a higher fee. Okay. When we ran the actual numbers, the fees on, somebody who had good credit wasn't going up that much. This fee savings on somebody who was a lower credited, you could call it high risk, but there was a lot of reports out there that saying a lot of these lower credit borrowers were actually not high risk. Anyway, they were having a considerable savings, upwards of $3,500 on the average loan. Okay, so MBA's statement on the FHFA rescinding its DTI-based LLPAs. Bob Brooksmith, CMB president and CEO of Mortgage Bankers Association, issued the following statement after the ruling came out yesterday. We have strongly opposed FHFA's planned debt-to-income loan level pricing adjustment since it was announced in January. We have led advocacy efforts calling for its removal. The proposed fees was unworkable for lenders. So again, talking about the work that was going to have to go into this from a lender standpoint, and would have confused borrowers and undermined the customer experience. We are pleased that FHFA engaged with industry stakeholders, recognized the negative impacts of the fee, and decided to rescind its implementation. MBA urges FHFA to continue its engagement to improve clarity and transparency regarding the GSE's pricing framework. We will continue our work with the agency, the GSEs, lawmakers, and the Biden administration on policies and actions that lower costs and advance sustainable access to homeownership while protecting taxpayers. Okay, and the spin in the mainstream media has been the Biden rule. That's how most people will know it, is the new Biden mortgage rule that subsidizes low-end borrowers. Okay, so I didn't think that ultimately this was that big of a deal. Mortgage difference business feels different. I wasn't the one doing the work, so the lenders were, and they ultimately got this reversed. Now, I didn't think this would work anyways. I didn't think stimulating the bottom up when you have no inventory and you have 20, 30, 40 offers on properties that are at the median price point or below in every market was actually going to win more home ownership for more people. Stimulating the bottom up is not the ticket to creating a more equitable housing, home ownership goal and vision for America. So hopefully maybe that'll be part of it, where it's like, hey, let's actually get more inventory onto the market at median price points or below. That's what the Biden administration should spend their time on, not how to save somebody $3,000 on closing costs who's going to be competing with 30 offers because there's no inventory in their price point. The savings doesn't go very far when you put in offers for 2 years and don't get a house. How many agents in the comments are working with somebody right now that has been home shopping and making offers for 2 years, maybe even 3? I was speaking with an agent yesterday, a lender yesterday, who said that he has somebody who's still sending out pre-approvals as he makes offers for, that started the process in 2019. Okay. So I don't care if you save all your closing costs. If you can't buy a house, it doesn't matter. And that's the real problem with today. We need to stimulate inventory at median price points and below, at affordable price points. That's where we need to stimulate. Stimulating from the bottom up is just going to create, more of a clog in the piping. It's going to create more of a backflow here. Okay. All right. Let's go over to Lawrence Yun, who is the National Association of Realtors chief economist. Great job, by the way. I don't know if you ever looked up Lawrence Yun's history of salary at, if your association is NAR, you should look it up. I've done podcasts on it. He's been there for a long time, and wow, it's fascinating that what the chief economist from NAR is pulling in. Lawrence Yun, our chief economist at NAR, called the Fed's latest rate hike unnecessary, stating that inflation has already started to calm. So Lawrence Yun getting paid almost seven figures to make comments that we make every day here on the hot sheet. Regarding the residential real estate market, Yun forecasts that mortgage rates will drop to around 6% by the end of 2023 and below 6% in 2024. We actually see a lot of Fannie Freddie, a lot of others saying that we could be below 6% by the end of 2023. He also expects home sales to increase in 2024 after bottoming out this year. His forecast for commercial real estate includes a decrease in valuations of commercial properties and a decline in total transactions. We absolutely believe that will be the case. Inflation will not reignite. Inflation will come down closer to 3% by year's end. So that's Lawrence Yun's prediction on inflation. He says it's calmed down while rents are still accelerating. Actually, Lawrence, rents are decreasing. Okay, so you might be looking at old data, but if you're looking at current data like we do on the hot sheet here, and like Barry Sternlight does, who controls 125,000 doors across the country, he's a billionaire. He models this thing every day. He says rents are decelerating right now, not accelerating. So I think Lawrence Yun, on that comment and this now BAM.com piece, just quite frankly doesn't know what he's talking about on rents that are still accelerating. There are markets like we talk about here, individual markets where rents may be going up, but across the country, we're seeing that rents are decelerating. Redfin's on board with that. Again, apartments.com, Barry Sternlight, who has a model of 125,000 doors, a billionaire. I'm gonna lean into that direction more than Mr. Yun. He also stated that rent growth will also begin to decrease because apartment construction has reached 40 or 50-year high. We've been talking about that for 3 months. It's already actually happened, Lawrence. Robert Dietz, chief economist of National Association of Home Builders, it's death by 1,000 cuts. It's impossible to build entry-level housing when you've got, before putting a shovel in the ground, $200,000 in regulatory costs. This is what I'm talking about, and this is what Biden can actually do to help the Biden administration can do to help the housing inventory. They can stimulate the top. I know that sounds a little crazy. You got to stimulate the ability for home builders. I'm not saying go send them a check. I'm not saying get Jerome Powell on the money printing machine and hand, builders don't need a stimulus or a PPE or something like that. What they need to do is get rid of these regulatory costs that are up front and say, we're going to remove them only if you build homes under this price point. Only if you sell these homes to borrowers that meet this criteria will move regulatory costs. If you're not going to do that, we're not going to remove them. That's how you can stimulate more inventory in a market that desperately needs it. Okay. They do. Builders, if you're a builder right now, or if you're working with a builder or a developer, or you talk to builders and developers often, that they have to jump through so many hoops, the roadways, protecting the salamanders, all the different things that they have to do before they can ever start building a home. And if you love salamanders, no offense there, I'm just saying there's a lot that they have to get through from a municipality standpoint, from a county standpoint, governmental standpoint, that is shackling their ability to create a product at a lower cost. Labor is already an issue for them. Building costs and materials are very volatile. What can we control? These regulatory nonsense costs that they have to deal with on every single project. Back to Lawrence Yun's thoughts. Home price increases are naturally good for homeowners. Everyone participates in wealth gains if you're a homeowner. Absolutely. And we know that the last 4 decades, homeowners their homes have appreciated upwards of 30 and 40% in each of the last 4 decades. Okay, so that's in nowbam.com. You can look it up. It'll be down below so that you can grab it in our daily download link where everything is available for you. What I did think, and this was Lawrence Yun, all these comments that he's making here. When were these? These were done at this week at the National Association of Realtor 2023 Realtors Legislative Meeting. So this is when all these comments were doing. I mean, if you look up Lawrence Yun's salary and he gets to do this like once a quarter. We do this every day. Hit the thumbs up for the hot sheet doing this every single day. And these guys get to do it once a quarter. Unbelievable. But I thought the most the best slide that I saw out of this, and this is for everybody, like we're going to get into a topic here right now about the home buyer's quandary and how they're stuck between this inventory and issue and not having enough homes. We know that home sales have come down to, here's a Wall Street Journal chart on existing home sales. All right. They've come down into the 4 million mark, well below what we've experienced at any point since 2018. Existing home sales, we're going to be at maybe 4.4 million is the number that NAR is projecting right now, seasonally adjusted annual rate. We are, and Lawrence Yun said in his comments that we're gonna bottom out on home sales this year, and then eventually in 24 we'll start going back up on total sales. I'm not talking prices, I'm talking total sales. So I did think the most interesting chart that he had was this one here: demographics drivers to housing demand. If you're an agent, this is something that you want to pay attention to. Where are those 4 million sales going to come from? Where are those sales going to come from in your market? Okay, where are the population gains? Where are the towns and the counties in which you serve that have a population gain, that have a migration inflow? Okay, so 2022 we saw 1 million more overall in the country for population. Deaths, we saw 3.3 million. Okay, are you in a market that maybe is aging out? Births, are you in a market where people, because listen, death, birth, divorce, these types of things, you got divorces down there. This is why people buy and sell. And so the 4 million homes right now are going to be driven by these big life changes. Okay, so deaths, births, 3.7 births outpaced deaths in 2022. Marriages, there were 2 million. This is a 2021 number. Okay, that's going to spur home ownership. Divorces, certainly there's usually 3 transactions in a divorce: the sell and 2 rents or 2 buys. And then turning 34.4 million turned 30 in 2022, prime buying years. Death, divorce, diapers, diplomas, diamonds. These are the reasons that people buy, and certainly going to be more of the buyers throughout the rest of 2023 as we're in this home buyer quandary, as reported by Wall Street Journal. Okay, so I thought this article was really well written by, I think it's Nicole Friedman, who writes a lot about real estate in the Journal. Home buyers quandary is nobody selling. Many are ready to move but don't want to lose the low rate mortgages they locked in a few years ago, crimping the supply of homes and keeping prices high. Thinking about this, so many people bought a home a couple years ago at this low rate, and maybe they've already outgrown it. Like the picture here on the Journal shows, this growing family here. Maybe they've already outgrown their home. I'm not saying that it looks like townhomes behind them. So maybe it looks like a townhome. So maybe they bought this townhome. They've already outgrown it. They realize, okay, my kid is bouncing off the walls everywhere. I want to get a bigger home, but they're locked into this rate. Or maybe they just had their first starter home when these rates dropped, to 2.5%, 3%, and they refied, and now they're like 2 years too long being in the wrong house, but they don't want to become that seller and have to get into that 6.5%, 7% interest rate. Okay, because they're locked in. This is like creating a backlog. It's the Cold War I've often talked about. And here's a great chart, and this is why I wanted to share the Wall Street Journal article with you. This chart will be down below for you in the daily download. All right, this shows how many active primary mortgages are in each interest rate category. Okay. So less than 2%, obviously that would be a rare occurrence, even in the low mortgage rates. But you get up to 2.5%, you're talking 2 million, just over 2.5%. You've got 3 million. In that 2.75 to 3% range, you have over 8 million active primary mortgages. 3%, over 4 million. You can see these numbers here. They're all over 4 million until you get up to 4%. Then when you get over 4%, it's still at 3 million. And 7% or greater, look at that, only 1 million active primary mortgages. Primary mortgage meaning the home that they live in. Okay, so this right here, this end of the chart here, 5% to 7%, this is why there are absolutely no refinances happening. Who the heck? I mean, unless you are hurting for certain in this category, 5% and over is going to refinance their loan today. Okay. Doesn't make any sense, right? Nobody's refining rather over here unless they're hurting. So these people really can't refi on the right. So this is why refinances aren't happening. This is also why we're not seeing the inventory that we need to see right now, is because all of these people from 2%, these homeowners from 2% to 4.5%, aren't incentivized to go grab a 6.5. You get these mortgage rates down to 5.5 to 5%, then you could see some of these people that are homeowners in the, call it 4 to 4.5 range. You know, if they're making a decision over 1%, you've got, what do we have here? From 4% to 5%, we've got 3 million, call it 12 million active primary mortgages in that 4 to 5%. So I'm just kind of back of the napkin there based off of this chart, about 12 million homeowners who are in that. You get a mortgage rate here, 5.5%. It's easier to make a decision to jump over there on either a sell and a purchase at 5.5. You know, obviously that's what we want to get the inventory, or some kind of move, right? Maybe a sell and wait and rent for a little bit, but knowing that the rates aren't going to go back up to 6.5, 7. To unlock all of this, I think you got to get something that looks like 499. It just feels better when you're at 499. All right. Interesting chart. That'll be down below for you from this Wall Street Journal article that was released yesterday. One more fun fact about mortgages: 73% of primary mortgages have fixed rates for 30 years. Okay. So 3 out of 4 mortgages have a fixed rate for 30 years. So that rate's not changing. And we saw how many of those are well below the current mortgage rate now and are well below 4%. All right. Which makes it harder for them to move. We need to see, again, starting from the top of the show, we need to see stimulation for affordable housing, and we need to see this interest rate come back to a 5.499 level. And that's going to unlock so much inventory and create a much healthier market, certainly for first-time home buyers. All right, some quick economy updates right now that I want to just rapid fire spit through. Market's down pretty big today as PacWest shares tumble 20% after regional bank says deposits fell 9.5% last week. So more shaky ground for regional banks. And the thing that can really hurt regional banks is going to be this commercial loan crisis that's potentially looming. More news in the economy. Wholesale prices rose just 0.2% in April, less than estimate as inflation pressure eases. Yesterday's hot sheet, if you missed it, we covered CPI, how much of the shelter and housing is taking up this CPI, and we did see a cooling of inflation in that report. The producer price index, which came out this morning, was supposed to come in at 0.3%, came in at 0.2%. All right. So more good news there. The headline PPI rose just 2.3%, down from 2.7% in March. It's the lowest reading since January 2021. So inflation continuing to show signs of easing. All right, so more good news there. We gotta continue to see that happen and create a theme. Also, last part on the economy: U.S. jobless claims rise to highest since October 2021. All right, so we're getting a lot of these since 2021 measures. This is a sign that the labor market is cooling, according to Bloomberg. Okay, so applications for U.S. employment benefits rose highest level since 2021. Initial unemployment claims increased by 22,000 to 264,000. I'm not rooting for people to lose their job. That's what Jerome Powell is doing. And so there you go. There's a chart there for you to show that jobless claims are going up. It's going to make their job easier to fight inflation if this market that's been strong, kind of cools down. All right. What we know is not cooling down is home prices. I threw in an old chart here for you in the daily download, just based off of that conversation earlier for people that are expecting this. Again, I've plugged this one before. This is a great one from Fortune to take out over the weekend for buyers that are expecting, with all the chaos going on, that they're going to see some big home price drop. Nope. CoreLogic and others are expecting home prices to actually go up as they have bottomed out. Okay. Let's take a quick look at the 10-year. Where we're at. It was down. Is it down? Is it down? It's down, not as much as we want. Oh, yeah, no, it is down as much as we want. Wow. Okay, big drop. Okay, so we're back under 3.4. We should see. I misread that. I thought this said 3.6 at first. Okay, so 3.362. It's great. We that's kind of been our low mark all year when we get between 3.3 and 3.4. This is great for the 10-year. We should see. And so they like the inflation news from yesterday and this morning. We should see this 30-year fix drop down. Yesterday, we projected here on the hot sheet would be between 6.5 and 6.6. That happened, 6.57. Maybe we can get below 6.5 today with where the 10-year is. That would be great. Be interesting to see where it comes in. Of course, we'll talk about that tomorrow on the hot sheet. Until then, today at 5 p.m. on the channel, we've got the walkthrough. Jeff, Byron, up until this week, we could follow 10-year Treasury on Mortgage News Daily, but now they want us to go to MBS Live for a fee to follow. Is there another site to track the 10-year? I track it on Wall Street Journal. That's what I'm showing First of all, Jeff, thanks for being here. Appreciate you. And you can just track it here if you'd like. But if you want up to the minute, I'm following on Wall Street Journal markets. Now I am a subscriber to Wall Street Journal, but I don't think you need to be for this one. If you do need to be for this one, just CNBC has a tracker, and that one's up to the minute. CNBC's is definitely free. May not be as robust as Mortgage News Dailies, but I find this one here. I don't know if this is available to non-subscribers from the Wall Street Journal, but I find this one to be give me everything I need anyways. All right. We got the walkthrough on the channel today at 5. And also, if you have yet to sign up to BAMX, get in there. It is the #1 marketplace in real estate. You can do it for literally a cup of coffee a month. We're providing just incredible value, live streams, BAM courses, and there are discounts to creator courses. Just check it out. The link is down below. Really appreciate it if you give it a browse and consider joining BAMX. I'll see you guys all here tomorrow on the hot sheet. Until then, toodaloo.